Welcome to the Deep Dive. Really glad you could join us today. We're digging into something pretty interesting from the business world, Build-A-Bear Workshop's first quarter results for fiscal 2025. We've gone through their earnings call materials, and, well, our goal here is to sift through it all, pull out the most important bits, the real nuggets, give you a shortcut to understanding their performance and strategy straight from them.
Exactly. These earnings calls, they're like a direct window into how the company views itself and its path forward. We're here to guide you through that, point out what really matters.
And right off the bat, what jumped out from this Build-A-Bear call, the headline seems pretty striking.
It is. They're calling it their best first quarter ever.
Wow. Okay, let's unpack that.
Well, at a high level, you're looking at double-digit growth on the top line, which drove record revenue for a Q1. And it wasn't just revenue. They saw margin expansion, strong performance, really, across all their segments. And maybe the most eye-popping number is the earnings per share growth, nearly 43%.
43% EPS growth. That's huge. But does best ever just mean slightly better than last year, or is something bigger happening here?
Oh, it definitely points to something bigger. It looks like they're operating at a fundamentally higher level of profitability now. So, just for context, their pre-tax margin rate this Q1, 15%.
Okay.
Now compare that to Q1 2019. That's the last comparable pre-COVID year. Back then, it was only 3%.
3% to 15%. That's quite a difference.
Exactly. It shows a really significant and seemingly sustained improvement in how they manage the business financially. Much more efficient.
So not just a blip, but a more profitable model overall. And I see they're also returning cash to shareholders. That usually signals some confidence.
It does. They returned $7.1 million just in this quarter through dividends and buying back stock. Over the last year, it's actually $37 million returned. Mm-hmm. And they still have board authorization for another $85 million, so there's runway there.
Okay. And they linked this strong performance back to their long-term strategy. You mentioned this is where it gets really interesting. They laid out 3 main strategic initiatives.
That's right. Their success seems built on 3 core pillars. Pillar 1 is all about the evolution and expansion of their experiential retail footprint.
Right, the core store experience.
Exactly. Enhancing that and growing where they offer it.
And how is that expansion playing out? It feels like they're showing up in some, well, unexpected places lately.
They really are. They've crossed 600 locations globally now. And interestingly, about 30% of those are outside the U.S. Across 30 countries. They gave some specific examples like new corporate stores in really prime tourist spots. Think Grafton Street in Dublin.
Ah, high footfall.
Definitely. But a lot of the growth is coming through partners. They mentioned opening in completely new countries like Finland and Estonia.
Estonia, wow.
Yeah, and apparently with lines around the mall when they opened. It shows the brand has real global appeal. They're also hitting travel hubs. Copenhagen Airport has a standalone store now, and even unique spots like Piazza San Marco and Venice, Italy.
Venice. A Build-A-Bear, that's different.
It is. And they're expanding other partnerships too. More locations on Carnival cruise ships, more with the Girl Scouts, bringing the total there to 28.
So it's definitely not just about sticking another store in a mall somewhere. There's a real location strategy, different models involved.
Precisely. They operate corporate-owned stores, partner-operated shops, and franchises. The international growth especially relies heavily on partners, but they were quick to emphasize they have a very high bar for these partners. The key is ensuring they can consistently deliver that unique, hands-on Build-A-Bear experience, maintaining the brand quality globally.
Makes sense. Any really big future projects on the physical store side?
Yes, a pretty significant one. They announced plans for a multi-level workshop at Icon Park in Orlando, Florida. That's a major tourist and entertainment hub.
Oh, okay. That sounds ambitious.
It does. It's slated for a summer 2026 opening, and they're actually breaking ground this July. And just for 2025, the plan is for at least 50 net new locations, with the majority being operated by those international partners.
Okay, so pillar 1, expand and refine the physical experience. Got it. What's pillar 2?
Pillar 2 is advancing their comprehensive digital transformation. This is more behind the scenes, less visible maybe to you walking into a store, but really critical for the business operation. Mm-hmm. They're in the final stages now of replacing some older legacy inventory management systems, putting in a new strategic platform.
Right, the tech upgrade. What's the payoff they're expecting from that? What does a better system actually do for them?
Well, the main goal is much better real-time visibility into their inventory. across the whole network, warehouses, stores, everything. This allows for, better data-driven decisions. Think about ordering, stocking.
Okay.
And it should make moving inventory between, say, e-commerce and stores much more fluid. Less manual work, more automation.
So fulfilling online orders from store stock more easily, things like that.
Exactly. The ultimate aim is to drive sales by just having the right product in the right place at the right time, wherever the customer wants to buy it, and of course, improving operational efficiencies along the way. It's part of a multi-year effort.
Okay, getting smarter and faster operationally. Makes sense. And the third, strategic pillar.
Pillar 3 involves continued incremental investments to leverage their brand strength, and that's coupled with returning capital to shareholders, as we mentioned. They made the point that their improved, more consistent revenue and cash flow over the past few years is what's actually enabling these investments now in global growth, digital tech, marketing, and critically new product development.
Product development. They highlighted a specific success there, didn't they? Something called mini beans.
Yes, mini beans. It's a really good example of this third pillar in action. It wasn't just, another stuffed animal. It was quite strategic. It's designed to offer something beyond the make-your-own-bear experience.
Yeah.
It's a smaller, lower price point item accessible, maybe an impulse buy, a grab-and-go kind of thing.
Like an add-on purchase.
Exactly. They called it a basket builder, something to add to the purchase when you're already there for the main event, potentially increasing the overall sale value and conversion.
And it seems to have worked.
Absolutely. They said momentum continued strong in Q1. The product line expanded 30% compared to last year. And get this, they've sold nearly 2 million mini beans units since they launched.
2 million, wow.
And what's really interesting strategically is that they're now starting to introduce these outside of Build-A-Bear stores.
Yeah.
They see it as a potential new growth channel.
Right, you mentioned testing them in other retailers, like where?
Yeah, putting them where people might not expect Build-A-Bear. They specifically mentioned testing in the U.S. in places like Hudson stores and airports, and Apple Green travel plazas, about 50 locations there. Plus, their international partners are putting them in their own toy stores.
So expanding the brand's reach beyond the workshop walls?
Exactly.
Huh?
And they're keeping the line fresh, too. They launched 50 styles in the first year, adding another 15 this year, including limited editions, trying to build that collectability factor.
Speaking of collectability, they also talked quite a bit about the teen and adult segment being important now. How does that fit in?
It's huge for them now, apparently making up 40% of their business, which, might surprise people who think of Build-A-Bear as just for little kids.
40% is significant.
It really is. So they're actively catering to this group with specific products, often things tied to pop culture or just unique, quirky designs. Examples from Q1 they mentioned were a strawberry Highland cow, a Pokemon character called Sweeper, and even an emo axolotl they dropped for April Fool's Day, kind of leaning into internet trends.
An emo axolotl, okay.
Right. And things like Stitch, which maybe started with a movie tie-in, have now kind of evolved into an ongoing collectible for this older demographic, too.
But they're not forgetting the core kids market, presumably.
No, definitely not. They said that remains strong. They had a good Easter season with their classic plush and accessories. And apparently these golden surprise eggs they do tripled their sales compared to last year. So it seems they're managing to balance appealing to different age groups pretty effectively.
Okay, let's shift gears slightly. Let's dive into the financial nuts and bolts from Q1. How did the actual numbers look?
Right, the specifics. Total revenues came in at $128.4 million. That's up almost 12%, 11.9% to be exact. Net retail sales, so their own stores and e-commerce, that was $119.6 million, up 10.9%. But the segment growing fastest was actually commercial revenue. That covers wholesale sales to partners and their international franchise fees. Combined, that was up 28.3%.
Wow, strong growth there. And what about the performance of individual stores? Like, were more people coming in, buying more?
Yeah, the store metrics were really positive across the board. They tracked 4 main levers. Traffic coming in, conversion meaning the percentage of visitors who buy something, the average price per item sold, or AUR, and the number of items per sale, UPT. All 4 were positive.
All 4 positive is good. Any standout detail there?
I think the most telling one was their domestic store traffic. It was up 3%. Now, that might not sound huge on its own, but they specifically contrasted it with the overall U.S. national retail traffic trend for the same period, which they cited as being down 3%.
Ah, so they're up 3 while the average is down 3. That's a 6-point swing in their favor. That's pretty significant, isn't it?
It really is. It strongly supports their point about being a destination retailer. People aren't just wandering by, they're making a specific trip to go to Build-A-Bear, often for birthdays or other celebrations.
Yeah, that planned trip factor could make them more resilient if general mall traffic softens, right?
That seems to be the implication, yes.
And profitability. You mentioned margin expansion earlier. Gross margin looks strong.
Very strong. Gross margin hit 56.8%. That's an improvement of 260 basis points, or 2.6 percentage points, year over year. And that gain came from both sides of the business, retail and commercial. On the retail side, it was driven by better merchandise margins, which usually means less discounting.
Selling things closer to full price.
Exactly. And also leveraging their occupancy costs, basically. Higher sales spread over fixed costs, like rent makes each dollar of sales more profitable.
Were there any pressures on the cost side, though? Did expenses go up?
Yes, they did mention some pressure there. Their operating expenses, SG&A, which covers things like store wages, marketing, corporate overhead, came in at $53.7 million. As a percentage of revenue, that was 41.7%, which was slightly higher than last year's 41.5%. They pointed mainly to higher store wages, increased healthcare costs, and just general inflationary pressures that many businesses are feeling.
Okay, so some cost headwinds. But even with those, pre-tax income hit a record.
That's right. Pre-tax income landed at a record $19.6 million for the quarter. That's up over 30% from last year. And it represents 15.3% of their total revenues. And that flows down to that record EPS number we mentioned earlier, $1.17. That reflects the higher income, but also the benefit of having fewer shares outstanding because of the buybacks. And they also had a slightly lower tax rate this quarter.
Got it. And finally, on the financials, how's the balance sheet looking? Cash position, inventory levels.
Pretty healthy. They finished the quarter with $44.3 million in cash. That's up 16% compared to last year. Even after spending that $7 million on dividends and buybacks, inventory was sitting at $72.3 million. That is up a bit from last year. They explained the increase was mostly due to a strategic decision to buy some core products earlier than usual, plus it included almost $2 million in costs related to tariffs being prepaid. But they stated they're comfortable with both the level and the mix of inventory they have on hand.
Okay, so a strong Q1 performance. Looking ahead then, what's their outlook for the rest of the year based on this start? So what does this all mean going forward?
Well, interestingly, they decided to maintain most of their full year guidance. They're still expecting record revenue for the full year 2025. They also reaffirmed the plan to open at least 50 net new experience locations, again, mostly driven by those international partners. And they still expect their commercial segment revenue, the wholesale and franchise part, to grow at least 20% for the year.
Okay, revenue and location plans unchanged. What about the profit outlook?
That's where they made a slight adjustment. They updated their guidance range for pre-tax income. The new range is $61 million to $67 million.
And why they update there?
They were quite clear about it. They said this updated range now fully incorporates the expected costs from the current tariff rates after considering their mitigation efforts. They estimate that net impact to be less than $10 million for the full year. The range also accounts for about $5 million in those additional medical and labor costs they flagged earlier.
Right, the tariffs. That's obviously a big topic for anyone importing goods. How exactly are they planning to handle those potential extra costs? Did they elaborate?
They did. And it's quite interesting how their specific business model gives them some buffers. They highlighted several factors. First, their growing global footprint acts as a kind of natural hedge because the U.S. tariffs don't directly hit sales in their international stores or partner locations. Second, tariffs only impact the merchandise cost component, not their entire cost structure. Third, they've already significantly shifted production away from China. Most of their products now come from Vietnam.
Less exposure there then.
Right. And for items they do still source from China, they often have dual sourcing set up, meaning they can potentially redirect those goods to international markets that aren't affected by U.S. tariffs. And finally, because they're a vertical retailer, designing, sourcing, selling their own stuff, and because many of their core products aren't super seasonal, they feel they have more flexibility than maybe a traditional wholesaler or importer would have in terms of adjusting sourcing, managing inventory timing, and even tweaking pricing or promotions if needed.
So it sounds like they feel they have levers to pull, even if there's definitely going to be some impact.
That's the impression, yes. They anticipate a relatively modest impact in Q2, with becoming more pronounced starting in Q3 as more tariff-affected inventory flows through.
They managed to pull off this record quarter while a lot of other retailers are facing challenges. Did they talk about how they've navigated the broader headwinds over the last few years?
They did reflect on that. They pointed out they've delivered strong results consistently over the past 4 years, despite navigating things like the so-called retail apocalypse talk, Brexit uncertainty, and obviously COVID. They attribute this resilience to disciplined cost management, maintaining a strong balance sheet, the general strength of the toy industry overall, and crucially, their unique positioning as that destination of special occasions we talked about.
The teddy bear hug factor.
Pretty much. They actually ended with a sentiment along those lines that a teddy bear hug is understood in every language and is a universal source of comfort and joy, positioning them well to manage through uncertain times.
That's a nice note to end on. And did they give any sense of how Q2 is shaping up so far?
Just briefly.
Yeah.
They indicated that the positive momentum from Q1 did continue into the start of Q2, and that they have, quote, robust plans in place for the remainder of 2025.
Okay, it sounds like a lot came out of the Q&A session too, things listeners might be wondering about, like capitalizing on movie hype.
Yeah, that came up, referencing the success of Stitch. Their take was interesting. While they're certainly prepared to capitalize on those big cultural moments when they happen like a hit movie, they feel less reliant on them now. They see it more as gravy, as they focus on controlling their own destiny with their core strategies. And Stitch itself has kind of evolved beyond just the movie into a collectible for that teen adult group.
They're responding to fast trends, like things blowing up on TikTok.
They feel they're already getting better at managing inventory for hot items, and the new digital systems we discussed should enhance that further. But they actually made the point that often they are the ones creating the TikTok trends with their products, not just reacting to them.
Ah, interesting perspective. Setting the trend, not just following. And that store traffic number, the plus 3% versus the national negative 3%.
They really leaned on that as evidence that Build-A-Bear is a planned trip, a destination people seek out for celebrations. They see that as a major strength in the current environment where casual browsing might be down.
Anything else on the partner stores or Mini Beans expansion?
Just reinforcing the high standards for partners. It's all about delivering the experience. And for Mini Beans, they reiterated those specific test partners like Hudson and airports and Apple Green travel stores in the US, alongside the international efforts, framing it clearly as a growth opportunity they're actively exploring.
One last thing from the Q&A. Any concern that maybe customers bought bears ahead of time in Q1, pulling sales forward?
They pushed back on that idea. The perspective offered was that people don't generally hoard teddy bears, especially since so much of the sale is tied to the in-store experience making the bear, which you can't really hoard or pull forward in the same way you might stock up on, say, toilet paper.
Right. The experience itself is perishable in a way. You do it when you do it. Well, this has been a really thorough look at Build-A-Bear Workshop's record-setting first quarter. We've seen how their strategic focus, expanding that unique store experience globally, upgrading their digital backbone, and cleverly leveraging their brand with new products like Mini Beans and targeting collectors seems to be really paying off, driving significant growth, improving profitability, even while they navigate challenges like tariffs and inflation. So as you think about all this, maybe consider how a brand that many might associate purely with childhood nostalgia has found a way to not just survive, but actually hit record performance in today's really complex retail world. It seems that by doubling down on the experience, being smart about global expansion, embracing the digital side, and finding creative ways to connect with new customer groups, they've unlocked some powerful growth paths. What does a Build-A-Bear story perhaps tell us about the lasting power of brands built on connection and memory, and maybe just how crucial adaptability is for any retailer today? Thanks for joining us for this deep dive. We hope it gave you some valuable insights into what's driving Build-A-Bear right now.